What is up everybody, Gifford here, and in this video I want to answer a question, how to avoid FIF tax. But before we get into that, we need to understand what FIF tax is and the difference between tax avoidance and tax evasion. Then what strategy we can apply to avoid FIF tax, or I should say to minimize the tax you pay. So I do get this question a lot because people can see that I've invested over 50,000 into the stock market and they're wondering how come I don't show this. And this is also why I don't have my face on this video. We're just going to keep it low key, but people have been asking for it, so I'm just going to show you what I do in this situation. So reading here, FIF or Foreign Investment Fund tax in New Zealand is a tax rule that applies when you invest in overseas shares or certain foreign investments. The government wants to make sure people don't avoid taxes by investing overseas instead of in New Zealand. So how this works in simple terms, imagine if you have a piggy bank in New Zealand and another piggy bank overseas. The New Zealand government can see your local piggy bank and tax the money you make from it, but they can't see inside the overseas piggy bank as easily, so they made a rule. If your overseas investments are worth more than 50,000 New Zealand dollars, you have to pay tax on them, even if you didn't sell anything. The tax is usually based on 5% of your total investment value, or the actual gains, whichever is lower. This applies most to shares in foreign companies, but not things like Australian listed shares, because New Zealand and Australia have special rules. So what does this mean? In New Zealand, if you invest and have a cost basis of $50,000 and over across all your portfolios, then you'll be taxed on that. It's basically a wealth tax. Why is that? Because the average person doesn't have $50,000 in stocks. Therefore, if you are investing that, they want to tax you because you're making income for overseas in their eyes. And that's a way for them to get tax money back on your investments. So here, tax avoidance is actually legal and it's okay to reduce your tax bill. So reading tax bill is a legal usage of tax regime in a single territory to one's own advantage to reduce the amount of tax that is payable by means that you are within the law. A tax shelter is one type of tax avoidance, and tax havens are jurisdictions that facilitate reduced taxes. So basically you should actually be maximizing the amount of tax you pay, because you're going to be paying tax anyway for your own money and your own investing. Now the other part of this is called tax evasion. This is illegal. Tax evasion means that you're basically not paying any tax at all for the money that you have invested overseas. Therefore, you're making extra income, and because you live in New Zealand and not paying on that, you're evading the taxes that you have to pay. So all platforms report to the IRD, so eventually they'll come around and they're going to hunt you down. I'll put a link in the description for that information from the IRD so you can get yourself clued up. My recommendation is, if you're making money, just pay the tax. So this is my current balance at the beginning of the year. Right now we're in just started February. It's gone down a little bit low, but you can see here the interactive brokers, I have 20,000, and Sharesies I have also close to 20,000. Hatch is 7,000, InvestNow is 5,000, and then I've got my private portfolio. It's easy to see that I have invested over $50,000 into the stock market, or I should say overseas stock market. So how much tax am I paying? So technically I'm not paying FIF tax, but I currently am, because I have a strategy that actually pays the tax for me. So I don't want to pay FIF tax right now because I don't want to pay tax on my $50,000 if I can avoid it. What I do is I invest under $50,000 to stay under that FIF tax threshold. As long as I'm not trading in and out of the same stocks again in a short time frame, then that means that I'm not a trader. I then invest in smart shares ETFs, which pays the FIF tax within the fund that I'm buying at 28% instead of 30% income tax. So you can see here is the personal income tax threshold changes that has come in. So we're now in 2025 and I would be right here. So I'd be paying 30% if I was over the threshold, as well as also paying tax on my $50,000. Now just remembering that your cost basis can actually be less than $50,000, but the stocks themselves can actually inflate to well over that price. Now just make sure that you understand its cost basis. So if the stocks that you buy under the 50,000 threshold goes over, like say over 50,000 to 100,000, then you're still actually not going to pay any tax on that unless you were to sell that and then to buy again going over that threshold. So the main benefit of why I'm doing this is basically, one, I don't have to pay FIF tax because I'm under that 50,000. It makes it really easy. I don't want that headache. And secondly, by investing in these ETFs, which I'm happy to do, I can then invest more of my money over that threshold, but the fund itself pays the FIF. And you can see here, biggest advantage is knowing that your tax rate is 28% because this is a pot. And it is actually okay to invest $50,000 and pay the FIF tax if you do understand how that all works. It's not a problem at all. People do that all the time, and that's okay. Just for my current situation, I don't want to pay FIF tax at the moment. Eventually I will have to, because I am putting lots of money into the stock market, but for me personally, I don't want to do that. And if I can just stick with the strategy right now, and I'm happy to do that, then I can prolong getting into this kind of stuff another year or two. So how do you go about buying one of these funds that pays the FIF tax for you? Well, it's easy. I'll show you one right here. We're in my Sharesies account here. It's got 90,000. While you see it's quite big, actually my only investments in there is just 19,600 because the rest is KiwiSaver in here. I like to have it all in one place, so this is really good. But anyway, click here into the Explore. Once you're into this here, just click all filters, and then you can go down to the NZX, which is New Zealand, and then click show 172 investments. What you can actually do is come up to the search and type in SMART, so SMART, and that's going to bring up all the smart shares. So these funds here are the ones that pay your FIF tax. So what you can do is invest less than 50,000. Once you've hit that, then you're happy to go into a fund. You just click one of these, and each one has its own sectors and then what it specializes in. You can see here the Smart US 500 ETF is the top 500 companies, so your S&P 500 pretty much, and that's got its own pricing there, which is $18.91. So it has this fund here, and then the underlining that this fund invests into is something like the S&P 500, or not something, it's exactly the S&P 500, and you got the same ones. You got the New Zealand top 50, but here obviously that's going to be within the FIF, it's going to pay it for you, but all these other ones here, okay, this inside these funds is going to pay the FIF tax for you, so you don't have to worry about it. So let's click into there and let's see what's going on. So if we go to show more, we can see here it points us out to a website and also the provider. The fund invests in the US shares and is designed to track the return of the S&P 500. So once you click that, you'll go into Smart Invest, which was formerly Smart Shares, and here it talks about all its other funds and just general information in here, right? So basically you're using your Sharesies, which is just sort of the wrapper around it, and it's investing in these funds. And with the slide I was showing you before, the biggest thing to note here is what are the benefits of ETFs, and we can see that Smart Shares ETFs are PI funds, and basically by saying it's PI funds, that's how you get the tax paid for you, which is 28%. And if we just chuck in Google just to confirm that, so how does a PI fund work? Portfolio investment entity, which stands for the PI funds, provide some individual and trustees investors with the benefit of overholding assets or investments directly. This is because PI funds will pay tax on behalf of such investors at their prescribed investor rate, with the highest or default PIR capped at 28%. So yeah, there's actually nothing really tricky or dodgy about what I'm doing. I'm just using the available tools that I have on hand and how much money I have allocated to investing, and now I do have a decent portfolio of over $50,000. I want to be smart about what I'm doing. I want to put my money that's underneath that, which is sort of tax-free, to make sure I'm in growth stocks. I'm going to be paying dividends anyway, income on my dividends. And so if you are using Sharesies, by the way, Sharesies is actually really expensive to invest in Smart Shares and how you buy it. There's a couple of issues there. Even though you have a plan that I've talked about in my videos and it makes it cheaper, overall Sharesies is really expensive over a long time if you're just invested in these PI funds. The best way to do it, and what I recommend, and you can look up other guides is there and then let me know what you think about it, is to actually use this platform called InvestNow. And in InvestNow, if you click into the fund selector, they have those Smart Shares or Shares Invest in here, Smart Invest, whatever they call themselves now, in here, and the ones that I'm invested in is the Foundation Series Total World. And basically you just pay a one-off transaction fee of 0.5%. There'll also be a currency fee in there as well, and then you can invest in it. So you hit there, click invest. Obviously you have to set up an account. I've done videos on this, and this platform is just a lot less hands-off. This is all about increasing the amount you put in and not really watching what the market's doing. Just keep investing at a set amount. This is really, hands-off investing here. And if you click the home screen, it's very basic, because the people that use this really are concentrated not on the market, but they're concentrated on gaining more income, making more income, streams of income to then invest larger amounts into here. And some people's accounts have gotten absolutely massive, and they're not worried about picking individual accounts. All they're worried about is working hard, creating a massive amount of income streams to then invest, which grows into massive amounts long term. And if we just go quickly into the performance section here, so I've invested into the Smartshares and it's already up by $56. Now I can't actually tell what percentage that is. That is a bit annoying about how they do this, but there is other reports. It's not going to be in this video of how I go over that. But yeah, let me know what you think about the InvestNow platform, but I think it is one of the cheapest if you are investing into these funds. So in summary, the FIF tax is essentially a wealth tax. You've got extra money invested overseas and they want you to invest it here, and therefore they're kind of making you pay tax on it, right? Also, understanding tax avoidance is a legal way to pay less tax via those PI funds that I've been talking about. And remembering that my strategy is my first 50,000 is basically tax free because I am staying under that cost basis to stay under FIF. And then what I'm using is I'm investing in these, it should be Smartshares PI funds, where FIF is handled for me in the funds themselves and capped at 28%. Now, I'm not going to be earning over $100,000 or whatever anytime soon, probably ever, but so I'm not going to be paying those high taxes anyway. The savings there isn't that great, but in the end it's still savings, and the most important thing is I don't have to worry about it. It pays it all there. It's in the InvestNow. They'll sort it out for me. And when I do my automatic tax accounting, that's fine. All done for me. Anyway, that's it for me today. Thank you very much for watching. If you have any questions, put some comments down below. I've also have the links in the description of the IRD and all the other information I have here, so you can read over them in your own time. As payment for this video, I'd really appreciate it if you hit the like button and subscribe to the channel, which is all about personal finance, property investing, and my stock market journey. If you want to hear more from me, you can head over to the Instagram, as I do regular posts there on my investing and stock market news. The trading platform I use is Interactive Brokers, Hatch Invest, Stake, and Sharesies for individual companies, and I use InvestNow for index funds. If you want to start investing, you can use any of my referral codes down below to start your own investing journey if you are from New Zealand. Again, thanks for watching. Click this video here if you're interested in my total stock market portfolio. Otherwise, I'll see you in the next video. Thank you and have yourself a good day. Bye.